Hello everyone and welcome to another video. So in this one I'm going to give you an update on my journey with Darwinex. So I'm doing Darwinex Zero, that means I'm starting from scratch, but there's also an option to do Darwinex Classic, which is when you import your old MetaTrader account. So let's get right into these statistics. I did start this account on the 3rd of April 2024, so a couple of months ago, and the current return since inception is plus 4.55% and the max drawdown is minus 5.34%. I'm still in the calibration phase if you look at this part right here. So trading days, I have finished that, so that is at 100%, but the risk calibration is at 58%. So I still need to execute some trades. I think it's gonna take me maybe 2 or 3 more months depending on the number of trades that I get, and then this calibration phase should be done. Then I will be eligible for getting actual capital from Darwinex, so getting into Darwinex or Darwinia Silver or maybe even Darwinia Gold a bit later. So it is normal for this calibration period to last for a longer time than, let's say, with a classic prop firm model, because with a prop firm model you can pass phase 1 and phase 2 in just a couple of days. If you gamble, if you put in a lot of size on the trades, it can be done. But with Darwinex it is a bit different. Again, Darwinex is a much more long-term game. It is much more serious. So with Darwinex you're looking at, let's say, 5 to 6 months for this calibration phase to pass. That is at least for swing traders. I am a swing trader. I'm trading only on the 1 hour chart and I get around maybe 4 to 12 trades per month. So that is around 1 to 3 trades per week. If you're a scalper, if you're more of a day trader, if you're taking more trades per day, then yes, you will finish the calibration phase sooner. So that is how the story goes. The calibration stage depends on how much trades you're taking, the quality of the trades, the risk management of the trades. So there is a lot of things going into these calculations, but for swing traders it's gonna take a couple of months, which is completely normal. So yeah, these are the current statistics. You can see the return graph right here. We start off very strong and then now in some drawdown, but still taking trades, still kind of being around break even. You have also these other statistics. Again, this is still a signal account because I'm still in the calibration phase, so we're not gonna get a lot of statistics on these charts, but I'm happy with my performance. I have had some very nice trades and the markets have been very corrective and range bound in the last couple of weeks and maybe in the last couple of months. So the markets have been pretty slow, and yeah, I have not been taking those big trending winners, but I have been taking some nice range bound winners. So basically buying the bottom and selling the top of the range, which was good to keep me in this break even phase while I keep trying out my trending entries, while I keep trying to get in on those nice big trends. So I'm happy with my performance. Not every single month will be a huge winning month. You will have slower months, you will have corrective range bound months. It is part of the game. And because of that, I want to take a look at some of the Darwins that I analyzed in my first Darwinex video. I want to see how they are doing in these tough market conditions. So first one is we have THA. Okay, we have looked at them in the first video and their return since inception is going to be plus 773.68% with a max drawdown of only minus 14.47%. Absolutely awesome results, perfect results. Assets under management 28.5 million euros. That is absolutely massive. They are taking 15% of all of the profits that they make on the assets under management. So I believe 70% goes to the actual investors, 15% goes to Darwinex, and then another 15% goes to the owner of this index, which is THA. So if you want to view all of these Darwins, you click Darwinia and then you type in the name of the Darwin that you want to analyze. Right here, put in THA, enter, and then you're going to get all of these statistics. So let's check out the most recent performance of this fund. You can view it right here if you go lower and you have return per month. See, so the track record is all the way from 2015, right? It's a huge track record. This is a really awesome trader. So let's look at the most recent performance. Let's look at 2024. So for 2024, this trader is down minus 1.3%. Now, does this mean that this is a bad trader? Okay, he is down from January to July, minus 1.3%. Does this mean he doesn't know what he's doing? No, okay, it doesn't. Look, all of the years prior were green, they were positive. So this is just part of the game. It is just one of those periods where the markets are a bit quieter, when there's not a lot of activity, and the strategy is just not performing as well as it did in some other periods. So this is not the cause of a concern. This is normal trading. You're gonna get periods of break-even trading, of a bit of drawdown. So this is absolutely normal. And look, this is a guy that has a huge track record going all the way from 2015. And even he has a period of, let's say, break even or a bit negative trading for a couple of months. So if you're struggling, if you're currently in drawdown, if you're doing Darwinex, if you're doing prop firms, if your strategy is not performing as well as it does usually, well, look, in most cases, it's just a slow period and it's gonna pass. How to determine if your strategy is broken? Well, through backtesting. Go ahead and backtest the last 5 years. Go and backtest the last 10 years of price action. I'm sure if your strategy is profitable, you will still find those periods of slower trading in your backtesting. So go ahead and backtest the last few years and you will see that you will get these slower periods of a couple of months, especially if you're a swing trader. So we kind of have a similar story here between my results and his. So I'm kind of, okay, I'm in the positive, but I'm not really performing that well. And for 2024, THA is a bit down, but look at all of the other years. I mean, these results are really good. This is beating the S&P 500, which is very nice to see. Let's take a look at another one, okay? So let's take a look at FFG. We also analyzed this one in the prior video. So this guy has plus 76.31% return, max drawdown minus 20%, so a bit of a worse drawdown than the guy before, but that's okay. And assets under management, 2.2 million euros. This is also huge, right? THA has 28. This guy has 2.2, but that is still absolutely massive. Can you imagine just making, let's say, 1% per month or 2% per month and then getting a profit split on these assets, on this size of assets? It's very, very good. It's very profitable. So let's analyze this one. See, these are going to be the results. So this guy started in 2022 October, had a great year, really good percentage. In 22 plus 32%, 23 plus 37%. So he beat me in 2022. But in 2023, I do believe I did have more percentage at the end of the year. But 2024 is tough, right? He's down a little bit, minus 3.52%. Now, is this a problem? Does this mean that this strategy is not working? No, okay, just again, it's part of the game, it's part of the market conditions. What would be bad if we saw like a minus 30% here, okay, that would not be good, but minus 3.5% in a couple of months, that's nothing. And it's only from March, right? Because January it was positive, February was positive. So in March and April is when the drawdown actually started. So this is nothing, and this is just normal trading. It happens to every single trader. So again, if this is happening to you, if you're stuck in a bit of a drawdown, just know that it is part of the game. What you need to do is you need to go and check your backtesting. Look at your backtesting results month to month and see if there are some quieter periods in your backtesting results. If you have done proper extensive backtesting, you will find periods like this. It happens, it's normal. So that is it for FFG. And now I want to touch on the risk engine that the Darwinex software uses, because I have seen some people complaining online, not really understanding the risk engine that is implemented right here. So this is actually Darwinex Classic, okay? Because on Darwinex Classic, I have found you can get a lot more detailed information about a strategy than just the Darwinex Zero Darwinia page. So if you want, you can create a Darwinex Classic account, it's free, and then go to Darwinia here, and on Darwinex Classic you will actually have access to more detailed information. So let's analyze the risk engine with this strategy. So this is the BLM Darwin, okay, BlackRock, and what we can see here is return since inception is plus 78.42%. Very nice. Drawdown is going to be minus 22.8%. That's okay. The return to drawdown ratio looks all right. And the Darwin was created back in 24th of February 2018. And these are the results. As you can see, most of the years are actually positive, all right, except 2020 and except 2023, and currently 2024 running a bit negative. But I would say these are okay results. See, 2018 plus 25, plus 1, plus 10, plus 58. So this strategy clearly has some years where it performs much better than other years. And that can happen as well. Maybe 2018 was highly trending, and maybe 21 and 22 were highly trending as well. I can actually say from my backtesting, 21 and 22 have been really trending years. 2018 was full of trends as well, if I remember it correctly. So it would make sense that if this is a trend following strategy, that you have these sort of results. Again, 2020 was rough. It was a rough, very volatile year, and 23 was a bit slower. It did not have those big movements, those big trends like the years before. And 24, kind of similar story to 2023, a bit of lower volatility and not a lot of strong trending markets. So let's now take a look at the underlying strategy of this Darwin. So this is the Darwin, this is the investable index, but what you want to see is this. So you go here and you click underlying strategy, and now you can see the real numbers. So the return is negative, and the drawdown, which is the number I want to focus on, is very bad. So minus 89.96%. If you scroll lower, you're gonna see the percentage made during the years. Again, started in 2018, finished now, currently running. But if you sum all of these numbers, I do think that this ends up being in the green. I'm not sure why it says minus 3.51, because these numbers seem like they would end up positive. Doesn't really matter. What I want to focus on is the big drawdown. This strategy definitely has a huge drawdown of minus 89.96%. So if this was an investable index, if this was the actual Darwin and an investor looked at the statistics, they saw this big drawdown, they would for sure run away. They would for sure not invest into this index. That is why the risk engine is extremely important, because it makes the whole strategy, it makes the whole package much safer and much more, let's say, favorable for investors. So compare this drawdown to the number that you saw in the actual index. Minus 22.8% in the last, from 2018. That's not that bad. I mean, yes, investors are looking at, let's say, 10 to 15 to maybe 20%. But even this, it's not that bad, because this track record is very long, all right? Also, investors, number of investors. This strategy actually has 12 investors, and it has around $24.7 thousand invested into it. Do you think it would have the same 12 investors if it had these statistics with this big, huge drawdown? It for certain would not have any investors. So what the risk engine does is it repackages the whole strategy, makes it more favorable for investors and more likely to actually attract real investors as well. If you go and check out some real hedge funds, some big hedge funds, you're gonna see some really small drawdowns, okay? So with a hedge fund with huge amounts of money, it is not about making 100% or 200% return per year. Yes, there are some years and some extremely good hedge funds that can have extraordinary, like 10x returns, or not 10x, but 2x returns, let's say. But most hedge funds are doing, 20 or 30% return per year, just beating the S&P with a small drawdown of, let's say, maximum 10 to 15%. That is just the reality. Actually, most hedge funds lose money. We learned about this in university, I remember. So most of these hedge funds on Wall Street cannot beat the S&P. So they barely make a return per year, and they're definitely not beating the S&P. But the small amount of hedge funds that can beat the S&P, that are making, like, let's say 15, 20, 30% return per year on average, with a nice drawdown of 10 to 15% maximum, those are the ones that investors really like and they're willing to put their money in. So that is the exact thing that Darwinex is aiming. It is aiming to create your personal hedge fund that produces similar downside risk to those big hedge funds. Because they know when investors see a huge drawdown, they will not be willing to invest. So don't think of the Darwinex risk engine as being something bad, because it's not. It is actually here to help you attract investor capital. And also the profit split is set up pretty much the same as a regular hedge fund. The investor gets 70% of the profits, Darwinex gets 15%, and I believe the actual trader gets 15% as well. And if you have a big capital that you're trading, then it's a very profitable business model. So if you want to learn how the risk engine works, I would highly recommend checking out this document right here. I'm gonna link it in the description of this video. So basically, what is value at risk? The value at risk is a way of measuring the risk of an investment, which answers the questions how much you might lose, how likely it is, and over what time span. So this is basically the formula. An investment having a maximum monthly value at risk of 6.5% with a 95% confidence level might expect to lose 6.5% or more 1 month out of 20. So 1 month out of 20 months can be a loss bigger than 6.5%. The flip side of this is that 95% of the time, or 19 months out of 20, this same investment will make more than minus 6.5%. So this is the formula that is applied to your Signal account. So when an investor invests into your Darwin, there is only 1 month out of 20 months where they are expected to lose more than 6.5%. Now, this is not set in stone because nothing in trading is guaranteed, but again, this is with a 95% confidence level. So if you want to learn which characteristics affect the risk, so it is of course trade frequency, it is the leverage and duration of trades, and it is market volatility and correlation of assets. So these characteristics also impact how the risk engine will transform your Signal account into the actual Darwin. And that would be it for this video, guys. If you're currently struggling, if you're in a bit of a drawdown, make sure you go to your backtesting results, and I guarantee you will see these quiet periods happen in your backtesting. It is normal, okay? So I'm in a bit of a stagnant period, but I know that the trending markets are just around the corner. I need to be patient and I need to just keep executing my plan. And you can see it, some other traders are struggling as well. So that is normal, especially if you're a swing trader. It's part of the game, and don't beat yourself up. Just keep following the plan and the trends will come. If you guys want to sign up for Darwinex, you can get 20 euros off by clicking the link in the description of this video. And if you want to learn how to swing trade on the 1 hour chart, well then check out zentumtrading.com. Hope you guys have a great weekend, and I will see you guys in the next video.